Is the stock market heading for a crash? With the S&P 500's high valuations, earnings yields lower than bonds, and the Warren Buffett indicator flashing red, it's time to dive into the data. The S&P 500's current price-to-earnings ratio is over 30, giving it an earnings yield of just 3.3%. Historically, the S&P 500's average PE ratio is closer to 16, with an earnings yield of around 6.2%. This means the market is significantly more expensive than its historical average, raising concerns about future returns. High valuations like these have historically preceded major market corrections. During the dot-com bubble, the S&P 500's PE ratio climbed above 30 before crashing. Similarly, before the Great Financial Crisis, valuations were approaching 30. When combined with rising bond yields, this pattern becomes even more concerning. Here's where things get even more alarming. The earnings yield of the S&P 500 at 3.26% is now lower than the yield on 10-year Treasury bonds, which is around 4.7%. Historically, stocks have offered a higher yield to compensate for their higher risk. With this crossover, bonds now look more attractive than stocks for the first time since 2010. The Warren Buffett Indicator compares the total value of the stock market to the economy's GDP. Buffett has suggested that anything over 100% indicates the market is overvalued. In the late 1960s, Buffett shut down his partnership, citing the lack of bargains, when the indicator was nearing 100%. In 2000, during the dot-com bubble, it surged to 150%. In 2008, it was again over 100% before the financial crisis hit. Today, the Buffett indicator is at a record high of nearly 200%, signaling unprecedented overvaluation. Meanwhile, Buffett's Berkshire Hathaway is sitting on over $300 billion in cash, waiting for better opportunities. These levels are unprecedented and warrant extreme caution. Despite these concerns, the economy has remained resilient. The S&P 500's earnings per share grew by 6% last year, showing that companies are still managing to deliver growth. However, slower growth compared to previous years suggests caution as economic headwinds persist. Over the long term, the stock market has always been a reliable wealth-building tool. But in the short term, expectations need to be managed. With high valuations, rising bond yields, and slower earnings growth, investors should brace for potential corrections and focus on margin of safety while staying committed to their long-term plans. Do you think the market is heading for a crash? Comment below and let us know your thoughts. Don't forget to like this video and subscribe for more investing insights.